Ladies and gentlemen, I'm glad you can join me this afternoon following the carnage that we had yesterday for markets. Seemingly, in just a couple of hours, markets went from, okay, we could have a year-end rally to, oh crap, the Fed could be raising rates soon and we're not going to get any cuts next year. And considering the markets had rallied so much since the election, that is a problem. Now, today, the problem still exists, okay? S&P is up 0.23%, but it's really just big tech. Netflix up 1.5%, Nvidia up 2%, Apple up 1%, Meta up 0.5%, Google up 1%, Microsoft up 0.5%, and Amazon up almost 2%. Exclude these top names, S&P would be down like 1% or so, give or take, okay? The RSP, which has been on a death spiral recently, is continuing lower. I mean, currently sitting at a new low you have not seen since at least September 16th, okay? It's been a lot of red candles in a row, and yesterday it was a massive one. So we're continuing to fall on markets. If you look at the advanced decline line on the S&P, taking another move lower, we actually peaked out on December 4th. Ever since December 4th, almost every day we've had more stocks declining on the S&P than rising. Again, hence the RSP's death blows that you continue to see. Now, this creates a pretty fascinating dilemma heading into year end and the first part of January, because markets are oversold. Markets have overextended to the downside. And the markets at this point, via pretty much every metric you can look at, is bearish. The sentiment is really, really negative right now. I mean, obviously, you can look at the RSP, look at the RSI on the RSP, that is the relative strength index. It's sitting at 23.13. Anything below 30 is oversold, but really once you get to 30, it's really bad at that point. Okay, last time you were close to this low, I mean, you're lower now than you were during the 10% correction from July 2023 through October of 2023. Let's just actually put a pin on that real quick. No, that was a 14% correction in the S&P. 14% correction from July through October. And the RSP only ever got down to the lowest point of 24. Today it's at 23. Okay, so markets are exceptionally bearish right now, which is interesting because the headline S&P is only down like 3.5% from its all-time high. Like, it's really not that bad for the S&P. Because of the outperformance in big tech, okay? Exclude big tech in this, S&P would be down closer to like 7-8%, okay? So big tech's kind of masking the damage that has been done under the surface, which is pretty fascinating. Now, Tom Lee today went on CNBC and said, quote, "The panic dip will be bought." He says, bottom line, this is a buy the dip moment, maybe more like back up the truck. The fundamentals did not change. I disagree with this. Fundamentals did change a little bit because we're not going to be getting cuts next year unless inflation comes down. I think inflation is going to come down more than expected next year, and that's going to open the door up for cuts. But some investors, bull thesis, they've been at least partially baking in a couple of rate cuts next year. It seems like that is no longer going to happen. Okay, so I do think things have changed a bit, but I think markets have already been reflecting that for a while. Again, yesterday was a bad day for the RSP. Okay, you were down 3%, but look how many red days you had seen leading up to the Fed. Like, you had already been pricing in a lot of pain up until the Fed. And again, even today, you are red again. So I think from a kind of structural standpoint, you are due for a relief rally. Okay, look at the CNN Fear and Greed Index. Okay, just take a look at this thing. It's at 30. on the bottom end of fear. Even yesterday, you were at 33, which was fear. So you're moving down 3 points today. Actually, you're moving down 6 points today, down to 27. Okay, markets are not in a great place right now. And as if you guys have been invested in the markets for a while now, you know when sentiment gets this negative, for the wrong reasons, does not matter what the reason is, you do tend to see a bounce, right? You do tend to see that's when the selling kind of ends. Okay. And I think you're pretty well there. I mean, look at the percent of stocks trading above their 50-day moving average, sitting at 31.23%. Okay. This was down massive yesterday. It fell from 56% at the high of stocks trading above their 50-day moving average to the low of 30.44%. Okay, that means 20% of all stocks yesterday alone fell below their 50-day moving average. That is a flush out. Okay, now could things get worse from here? I mean, sure. We do have economic data tomorrow, and I will share that with you here in this video. But every single metric that you can look at that shows investor sentiment, it has gotten remarkably worse. Even the AI investor sentiment survey that really didn't capture the panic yesterday, that'll be reflected in the next survey that comes out next week. Bullish investors nonetheless fell to 40.7%. Down from 43.3% last week. Neutral investors rose from 25.0% to 27.9%. And bearish investors surprisingly actually fell from 31.7% to 31.6%. So based on that metric, based on the percent of stocks trading above their 50-day moving average, based on the CNN Fear and Greed Index, the RSP's RSI, like all of these things are screaming the markets are maybe a little bit too negative. Now, I've been calling for a correction in Q1 2025. What's fascinating, though, is you've gotten a correction under the surface of this market. You know, again, the RSP from its high is down 7.2%. That's kind of what a correction tends to be these days. Now, again, the S&P is only down 3.5%, but it's really just big tech that is carrying the weight there. Surprisingly enough, what I think personally this could be setting us up for is maybe big tech falling in the first part of 2025 and the rest of the markets to kind of catch up. Okay, kind of an inverse to what you've seen over the last three weeks or so. That could definitely be a reality. Okay, I know that kind of sounds cliche because everyone believes in the broadening, but they're not putting their money there where their mouth is as of recently. Okay, now another thing that I will point to is the VIX. Okay, the VIX yesterday hit a high of like 28. The VIX doesn't tend to stay at these levels. Okay, when fear shoots up like this, you tend to see people kind of relax. When people relax, you tend to get rallies. Okay, kind of like August 5th, where the VIX hit 65. Okay, of course it wasn't going to stay there. It was a trade that was blowing up, the yen carry trade. Okay, markets rallied 20% from August 5th until essentially, now, and the VIX fell during that time, right? The VIX actually fell the next day down to 27. Okay, kind of like what you're seeing today. The VIX is down 15% today after rising 75%. So when you get these VIX spikes, that tends to actually be a bullish time for markets following that initial fear, or that initial, panic. And at this point, are we going to, go above 28 where we were yesterday? I don't think so. Okay, we're going to have to see something really bad in the data. You're going to have to really spook markets at this point to get more fear to come into markets. Markets are already very, very fearful. Now, maybe there's a chance of, more cuts getting priced into markets next year, although I don't know if that's positive or not, because that would presume, weaker or slower economic growth. Now, here's the deal. Today, you had some pretty weird data that came out. GDP growth rate quarter over quarter for Q3 came in at 3.1%, expecting 2.8%. So that was good. Price index came in at 1.9%. The previous estimate was 2.5%, so that's good. Initial jobless claims came in at 220,000. Expectation was 230,000, so that was good. But manufacturing index for the Philly Fed came in at negative 16.4. Last month was negative 5.5. The estimate was 3. So that was like blowout bad data. Okay. Continuing jobless claims came in better than expected as well. But all of your Philly Fed data came in really bad. Business conditions at 30.7, last month 56.6. CapEx index came in at 18.80, last month was almost 25. Philly Fed employment came in at 6.6, last month was 8.6. Let's see, Philly Fed new orders came in at negative 4.3. Last month was 8.9. Philly Fed prices paid came in at 31.2. Last month was 26.6. So inflationary pressures in the Philly Fed data, and then everything else missed expectations. So kind of weird. Real consumer spending quarter over quarter came in at 3.7%. We were expecting 3.5%, so more spending activity. And then existing home sales came in at 4.15 million, expecting 4.07 million. So that beat. And existing home sales month over month came in at 4.8%. We were only expecting 1%. So very weird data across the board, just very mixed. Now, tomorrow we get core PCE month over month. If this comes in line with expectations or even lower than expected, you're going to see the markets probably bounce back quite a bit. Okay, it's probably going to be a really good day tomorrow if that core PC number comes in good. Now, personal income month over month is expected at 0.4%, and personal spending month over month is expected at 0.5%. Best case scenario would be a lower core PCE and good spending data. Okay, that would suggest that maybe lower inflationary pressures and a strong economy, which is really the best of both worlds. We want to be careful with the whole rate cut thing, because if we start to get rate cuts at this point, and if we start to price in quite a few rate cuts, the economy may be in a not so great place. So that's something to consider. Now, for January 29th, 2025, following the Fed yesterday, there's a 93.4% chance the Fed will pause and only a 6.6% chance the Fed will cut. For March, there's a 57.7% chance the Fed will pause and almost a 40% chance of a cut. April, there's a 45.1% chance of a pause and a 43.7% chance of a cut. So you're actually not pricing in the first Fed rate cut again until June 4th, 2025, where you have a 43.9% chance of a cut and a 36.5% chance of a pause. And then you're pricing in a pause again for the July meeting. So between now and at least July 16th of 2025, you're only pricing in one cut. I think we're going to get more than that. So I think, inflation is going to come down more than expected. And that is a part of the bull thesis for next year for small and mid cap names. I'm bullish on those areas. I'm bullish on cyclicals. I'm bullish on industrials. Okay. A strengthening consumer, if you will. And I think there's upside. There's going to be upside surprises to what the markets are now expecting for the path of the federal funds rate. I think by July, we could actually have 2 or 3 cuts if inflation comes down more than expected. And that would be generally a positive as long as the economy is holding up. So I do think the situation is a little different now. I think it's a little weird now, if I want to say that, for the broader markets, because I was expecting that correction in Q1 2025, but your sentiment levels are already so negative that maybe you could actually see a good first start to January, although I could plausibly see big tech selling off and the leadership really going to more of a broader kind of rally. And that could send the S&P lower, but would, benefit most people's portfolios. So kind of weird. Not going to lie. It's kind of hard to say what's coming next for markets in this kind of with this kind of setup that we have, but I do think you are due for a bounce soon. Now, do I agree with Tom Lee? It's time to back up the truck here. Probably not. But if you're not in your cyclicals, if you're not in your small caps the way that you want to be for next year, then I think now is a great opportunity to get allocated to those areas. But then again, I'm not a financial advisor. I'm not a financial planner. So come to your own conclusions. But let me know your conclusions down below in the comment section. Ladies and gentlemen, have a great rest of your day. That's going to do it for this video, and I will see you in the next one.